Welcome back to our intermediate financial accounting class. We have spent a lot of time talking about deferred taxes. Lots of different segments, long segments and examples. This is one of the most challenging topics that we're going to get into. Although, hopefully it doesn't feel too challenging. Really, if you can get comfortable with that graph, GAAP to tax, it really is just a lot of plug and chug. Time consuming, but not really hard to understand or know what you're doing. Hopefully you're feeling that way about it. If not, please make sure you go back, take a look at the lectures, go back through the examples, and let me know how I can help. For now, we're just going to take a few very quick minutes to wrap up our discussion of deferred taxes by finishing up the last year of our comprehensive example. Before I get into that though, let me just talk about quick minutes. I know every minute is 60 seconds, but we have a little 3-year-old Michael, who is just absolutely adorable and also very rambunctious. And when he gets into trouble, then he has to go to timeout. And he's always asking us when he has to go to timeout, are they going to be long minutes or short minutes in timeout? Now, for us, 3 minutes is 3 minutes, but it's become kind of a joke in our house to talk about long minutes and quick minutes or short minutes because of Michael and his questions as he's sitting there in timeout, crying because he's jumped off the furniture or whatever it is. So anyway, that's where the quick minutes comes from. Also a little story about our 3-year-old. Hopefully you don't mind a little aside like that, but we should get back to deferred taxes. So let's jump back into it. Again, hopefully you've already tried this. For year 4, we've assumed income before taxes stays constant throughout our example. So that's $100,000. Life insurance premiums, again, they stay constant every year, $500 a piece. We've got to look at our depreciation and our warranty expense. And we actually have one more this time because that rent revenue has finally kicked in. So I've got the depreciation and the warranty that I've been dealing with, but I also have a difference in rent revenue that I need to look at. So for all of that, of course, we jump right to our PowerPoint slide where we can draw our graphs, since that's the best way to do this part of our calculations. So let's see, this time we have depreciation, we'll have our warranty, and then we'll have our revenues. For GAAP purposes, again, we're using straight line depreciation. So depreciation expense for GAAP is 120. But at this point, we are actually fully depreciated under makers. Let's take a quick look at these numbers. You can see makers is 150, then 228, then 222, and that wraps up the full $600,000. So there's nothing left for years 4 or 5. So in year 4, my tax amount will be 0. So if I'm going to go from GAAP to tax, I'm going to need to add 120,000 for the first time now. Instead of helping us reduce our tax liability, depreciation is actually going to add on extra taxes that we have to pay now because we've gotten these tax breaks in the past, and now it's time to pay the piper, so to speak, and actually pay the tax amount. For the warranty, again, $20,000 was a set assumption for the first 4 years, and we're on the last of those 4 years. We paid $21,000 in these warranty expenses. So if I go from GAAP to tax, I need to drop by 1,000 to get there. Revenues, we probably need to take a look at the revenues to make sure we're comfortable with what's going on. So let's go back to our instruction slide. We got $25,000 of rent revenue to cover year 4 and 5. All of the money came in year 4. So for GAAP purposes, I record $25,000 each year, 25 in year 4 and 25 in year 5 that I've earned. But since they paid all of the money in year 4, tax law says I have to record all $50,000 as part of my year 4 tax revenues. Let's go ahead and put that into one of our drawings. So for GAAP, I record a $25,000 revenue, $50,000, because all the money has already come in. So if I go from GAAP to tax, from $25,000 to $50,000, both positive numbers, gets me $25,000. That's my adjustment, and it's positive. So let's see, we have positive 120, negative 1,000, and positive 25 that need to go into our Excel spreadsheet. There's the 120, we have the negative 1,000, and the positive 25. Now in this case, we don't have an NOL, which is good because we couldn't use it as a carryback anymore anyway, because year 3 had an NOL, so I have no taxable income to cover there. Year 2 had an NOL, I have no profit I could cover there. I didn't get to cover all of my taxable income from year 1, but I'm too far out. I'm 3 years out now, and I can't go back 3 years. I can only go back 2 years. I also have no NOLs to move forward because I used all the NOLs going backwards. So I'm just going to have to pay on this $244,500, and my tax rate is 34%. So I end up owing the government for this year $83,130. Now we jump right into step 5. Again, we're only looking at future years. So since I'm in year 4, the only year that matters is year 5. So I'm going to get rid of year 4, and now I've got $40,008, this liability for my depreciation that I'm going to have to eat next year as I wrap this up. I still have a little bit of a deferred tax asset for the warranty, but I'm not done. I'm not done because I have 3 adjustments up in my step 3 taxable income calculation, and I need a table for each one. So I've done depreciation and warranty. I need to create a table for the rent revenue. So let me do that. I'm going to copy these rows and insert them right here so that it gives me a table. So GAAP revenue and tax revenue. And this will be revenue. And I just realized we've gone all through this example and I've left this as depreciation the whole way through. That's really annoying. You've probably been laughing at me the whole time, but don't tell me, I don't want to know. We'll just pretend I had it right. So let's see. These numbers are all taken care of. The adjustments are all there. I do need to put in the numbers for year 5. For GAAP, I recognize $25,000 in rent revenue each year for years 4 and 5. So in year 5, I recognize $25,000 in rent revenue. For tax purposes, I've already recognized all the revenue in year 4. So there's nothing to recognize in year 5. So I would have a net difference in revenue of $25,000. That's a deferred tax asset, which makes sense because I paid more this year than I thought I should have to, because I had to pay on all $50,000 instead of just the $25,000 that I earned for GAAP. Now I've got to update my net deferred tax number. It's just looking at these first 2 numbers. So I need to add that $8,500 in there. That's what I want for my net deferred taxes. We'll come down to our T account and we'll put that $28,900 credit into our T account. And for the first time, the balance is dropping. So to get from $77,860 to $28,900, I need a debit of $48,960. So let's see here. Income tax payable will be very large this time, $83,000, which is going to hit the company quite hard when I've been getting refunds and haven't had to pay out any money in taxes for the last 2 years. Deferred taxes will have a debit of $48,960. So my income tax expense will be $34,170, much lower than the income tax payable because I've already recorded this income tax expense in previous years. I recorded it as I built up this deferred tax liability. So now as I'm kind of paying off that liability, notice it going down, then I don't have to recognize as much expense. It's already been recorded. Let's see, we'll wrap this up by finishing the income tax expense section of my income statement. And to do that, I've got the $83,130 that's current taxes linked in just fine. What I'm missing is the deferred taxes, and this time I debit a liability, so I'm paying off that liability. It's reducing the expense because I recorded the expense in the past. So there's my $34,170. And my net income stays about the same as it has in the past, even though I'm paying out a lot more cash. Before we can wrap up our discussion of deferred taxes, we do need to take just a minute to talk about the differences between US GAAP and IFRS under this important topic. The good news is that there aren't really many differences. This is one area where the two standards really are essentially converged. So just a couple of minor tweaks that we need to discuss under IFRS. First off, you remember that under US GAAP, we have to use the enacted tax rate. So it actually has to be passed into law before we can use it in our deferred tax calculations. Under IFRS, that's not the case. If it is substantively enacted, then you can use the new tax law. Substantively enacted means it's almost there, and every sign indicates that it's going to become the new tax law. So for example, in our US system, if it has passed the House, it's got strong support in the Senate, it hasn't quite gone to the president's desk yet because the final Senate vote is a couple of days away, but the president said he's going to sign it, that would be close enough to be substantively enacted, and you could use that tax rate for deferred taxes. The other difference is in the way we adjust our NOLs for write-downs. Under US GAAP, if there's a reason to believe it's dropped in value, then we run a test and we make the write-down to an allowance account if we have to. Under IFRS, we switch our perspective. Instead of assuming it's okay unless there's a reason to believe otherwise, we assume it's lost value unless we can prove that it has not. So every year we have to go through and show, yes, I can still use this NOL. Here is why. My net income is strong. My taxable income looks like it will be high enough to use it over the next few years. Tax rates aren't dropping. And you justify the ability to use the NOL instead of looking for a reason why you might not get to. And those are the only two differences between US GAAP and IFRS. Now, we've done an awful lot with deferred taxes. We've spent a lot of time here because it is a challenging concept to wrap your head around. Hopefully you've tried it and practiced it and you're feeling really comfortable with it. If not, please go back and try it again, watch it again, look at the examples again so that you really are comfortable with this really important idea. Taxes are so crucial to a business. We have to get these numbers right and be able to report them to our shareholders and our managers and be able to explain them. So even though a lot of us don't plan on going into tax, we still need to be comfortable with these basics. With that, we're going to wrap up and close this discussion of deferred taxes. When we come back, we'll be moving on to the last piece of wrapping up our income statement. More fun stuff to come. We'll see you then.